Okay, well, welcome everyone to this webinar on Recession's macro views. We're living through an interesting, challenging time, pandemic, economic slowdown, kids interrupting our teleconferences as we all work from home. And I think the strong attendance here suggests we're not alone. So we wanted to share with you what we're seeing and how we're thinking about multi-asset portfolios. My name is Salman Beg, and I'm here today with my colleague, Florian Ielpo, Head of Macro Research at Recession.
Hi.
So let's get started. Florian, the rapid spread of the coronavirus has been a significant exogenous shock to the global economy. Could you speak maybe to what you're seeing in terms of the macro data and its likely path ahead?
Yes, of course. So we've been through a rapid change, I would say, in our macro scenario that reflects the rapidity of the shock that we are currently witnessing. Let's say that at the end of the month of Feb, we were thinking of a significant slowdown given the measures that we're currently witnessing. We are now expecting a large and significant recession. So the question we're still asking ourselves is, how can we measure this phenomenon and what is the extent of the damage? Because we think that in terms of portfolio management, it makes a lot of sense. We think of that in terms of triangulation, meaning that given that we're faced with a new shock, we are looking at different tools, different analytical tools. And if we could go on page 2 of the presentation, you would see one of them, which is our growth, our world growth newscaster. I'm not sure you can see it now. Yeah, excellent. This indicator is basically, if you're familiar with the multi-asset side of Recession, maybe you've seen this chart already in the past. We've put together 5 years ago a set of indicators to help us measure the biggest risk we see on the macro front. One being, of course, the risk of a recession. The chart you have in front of you is basically our world growth newscaster. It's a mixture between different economic data series that are recomputed on a daily basis that helps us track with what's currently happening in the world in terms of growth and where can we see the risk now in terms of recession. And as you can see from this chart, we've had recently a downturn in the economic data that you can already see if you follow close enough this red line. This is a reflection of the fact that some of the PMI-related survey and as of today, the jobless claims in the US are posting extraordinary downturns with very, very low level or very, very high levels in the case of jobless, which is creating a first indication that the economic momentum is collapsing right now. Now, this technology, of course, is based on the fact that we can measure the underlying economic phenomenon. As you said, Salman, basically, we're currently faced with an exogenous shock, meaning a shock that does not come from the economy itself, which means that it takes time to gather statistics to be able to measure what's currently happening in the underlying economy. But there is one thing that we can do, and this thing is this orange line that you can see next to the dotted line, which gives what we can expect in terms of the change in our indicator. And this orange line reflects the average change in our growth newscaster during the past 3 key recessions in the world, which is the recession in the 90s, in 1990, the recession in 2001, and the recession in 2008. And the combination of these three, on average, was about minus 0.37 change in our index. It's a Z-score, which gives the graph that you have now, which is clearly pointing towards, which would be clearly pointing toward the entry in a recession, which we expect right now. Now, this, of course, relies on the fact that we have statistics making it possible to measure what's currently happening. We think that this shock is new, which means that we need also maybe some new tools to be able to measure, to triangulate again what's currently happening with another source of data. And the newscaster, not the nowcaster, but the newscaster, is an indicator we've recently put together, which makes it possible to look at high frequency data to what's happening in the media, the news that we're getting on the growth side. Salman, would you walk us through page 3, which explains the work that's been done around this indicator?
Yeah. So as Florian mentioned, we've developed a sort of new systematic indicator. We're calling it the newscaster. It basically is an indicator that's tracking public reporting on economic growth across the world. It's intended to complement our existing nowcaster by making use of the latest technologies and alternative data, essentially summarizing how the world at large is assessing the impact of any particular event on the larger economy. It's intended to be faster moving, and indeed, since late January, it's after hitting basically a neutral level. As you can sort of see from the arrow, it's been on a one-way march south. Initially, this was driven by reporting in the emerging world, in particular China, where we saw the impact of the economic impact of the virus there. But since about mid-February, the negative trend has been basically driven by the developing world, coincident with the spread of the virus into the Eurozone, Europe at large, as well as the US. And we've now seen, basically since that period, news outlets are focusing on the economic fallout of the virus. At this point, the newscaster, this indicator, is past the levels it hit back in December 2018, when there were fears of an impending recession. And it's now getting close to par with its levels during the onset of the Great Financial Crisis in late 2007. So the indicator here, the news indicator, is also portraying a pretty negative picture. Again, we want to look at things from multiple perspectives. These are just two ways we're looking at the current situation. Florian, I know you've done some work, some top-down analysis on what the impact of quarantines are likely to be for the U.S. and Eurozone. Perhaps you can share those results.
Yeah, and that will be the third element in the different angle that Salman was mentioning. If you would like to go on page 4. On page 4 of the presentation, you will see the work we've put together around trying to assess the impact of a scenario, of a macro scenario where the quarantines would be weighing on what we could be seeing in terms of demand. The shock in China was mainly a production shock to some extent. Of course, consumption was down around the areas with the quarantines, but the arrival of the virus in the US and in Europe actually raises the question: what could be happening in terms of consumption, and what would be the impact on the overall growth? How much GDP growth would we be destroying? This chart is basically made of two elements: the money needed and the money promised. So the money needed is a measure of what is the extent of the economic damage in terms of billion US dollar coming from our scenario. Our scenario is basically based on the research we put together in terms of analytics, and with a strong comparison with the academic literature on the flu model, which is the model that helps measure the potential impact of a quarantine over a given economy. And overall, our computation led us to think that we expect now for Q2 this year a shock of -5% in the US and in Europe. -5% for Q2, which is a big shock in terms of economic growth. It's bigger than the fourth quarter of 2008. So it's a very significant macro shock. That is our core scenario that you can see here. It involves basically that 2020 would be a negative GDP growth year, meaning a recession year, both for the US and for Europe. In the case of the US, we would have a GDP of -2.6%, -2.6% GDP, and -3.5% in Europe. So a negative GDP year, recession year, basically. When you multiply this -5% by the GDP of all the countries you can see in this chart, you get the first column on the left on this chart, and you can see that the potential money destruction the potential wealth destruction would be of about 2.5 trillion US dollar worldwide, which is a very significant shock. It is to some extent a large portion of the world GDP. We have also a risk scenario in the case that this quarantine would be lasting for more than 2 months, and or that it would have consequences that would make of it not a temporary shock, the fact that the virus comes in and then comes out, and that's supposed to be temporary. If it's not temporary, then investments start to be impacted, and that's what you're seeing in the risk scenario. The risk scenario is of a destruction of about 8% of GDP growth for Q2. It's that would be a very, very significant shock. So that's where we stand. We oscillate between this core scenario of 2.5 trillion US dollar destruction and 4 trillion US dollar destruction of GDP.
So, looking ahead, Floyd, as you mentioned, we're thinking of this, at least currently, as temporary. I think many others think similarly. A key question, given that, is both for the economy and for investors, is what the response will be. How effective will the response be from both fiscal and monetary authorities? Maybe you can expand a little bit on the chart in terms of the right to money promise and what that's looking like at this point.
Yeah. What you can see on the right part of the chart is basically what we've been collecting so far in terms of engagement of countries, in terms of money spent for this to counter the effect of the coronavirus. You have two different types of intervention. The first one is basically direct support, mainly the US policy. They intend on providing money directly to their citizens in order to offset part of the drop in terms of revenue, so that not to offset too much of the consumption. We think that that's very effective from a fiscal policy standpoint. The European answer is a bit different. It's actually a little of direct support and a lot of loans, meaning that if you're an SME, if you're a corporate, if you're a household, you need money, you need a bridge loan so that to be able to make it through the storm, to make it through the pandemic, and several funds have been set up to be able to provide that money to the public. We don't think that loans are as effective as direct support. That's the first imbalance we're seeing. We'd like to see more direct support, and if possible, a direct support that would potentially equate the core scenario need in billion USD, at least to make sure that this thing remains something temporary. And the second element, the second biggest imbalance that we are seeing, is the fact that most of the direct support is actually coming from the US. So a program with about 2 trillion is currently going through in the House. And we think that that's the appropriate answer, yet we are disappointed to see only the US giving that answer. So this imbalance, this double imbalance, is, in our view, a significant problem to dealing with the current consequences of, again, this very significant blow that we are expecting now.
Well, so I think quite rightly, the view we've got is fairly dour, fairly negative. One of the attendees maybe is looking for a silver lining and has asked, what could make us more positive about the current situation? Maybe you can address that, Flo.
Yeah, of course. We are seeing three main triggers to go back into markets, broadly speaking. The first of these triggers is, of course, the stabilization in the health situation, the fact that, well, basically the situation goes back under control, which is not yet the case, at least in our understanding. But the first element, of course, basically that the origin of the situation. The second element, as discussed, is the fact that we'd like to see a more balanced fiscal plan, more direct intervention, especially coming from Europe. We're seeing hints that these countries are going in that direction, but it's only the beginning of it. That's the second element. And the third element would be to see even lower valuations in terms of equities, in terms of what we call growth asset in our framework. So every financial asset that would be profiting from growth overall We know valuations are already low, but we're still of the opinion that we could see lower levels if nothing is done properly. Nothing, if the fiscal answer is not strong enough, combined with the monetary answer we've seen from the Fed, mainly, and the ECB as well.
And then we have another question from the audience. This one, in many ways, the opposite side. What could make the context worse, in your opinion?
So we've actually working on that case quite significantly. There is one big tail risk that we're thinking of, which would be related to market liquidity. We fear that, given the extent of the macro shock, and in spite of the 3 interventions of the Fed, followed by disappointing signals from market, we could see a liquidity crunch across market, which would be the catalyst to seeing lower levels in terms of equity. The Fed did a lot and is still doing a lot in terms of treasuries liquidity. Having said that, it hasn't done anything, and it can't for them do anything when it comes to equities for now, and for a certain portion of the credit market where we see risks. We have notably the ETF that could be contributing, we would say, to this liquidity gap, and that's in our case the tail risk, the absolute tail risk.
Well, that's. I think it's a testament to how challenging of a period we're facing right now, when one of our tail risks is a liquidity shock after this macro shock. Well, thank you, Florian. I think we're about out of time. I want to thank Florian for taking the time to speak about these challenges facing investors today, and to also thank you, the audience, for listening and engaging. If we didn't get to your question today, we'll try to follow up individually, and you can, of course, reach out to your sales contact if you have any additional questions or requests. Thank you again. Stay safe, and we look forward to speaking to you again at the next Macro Views Live.
Thank you very much.
Bye-bye.